$1 trillion. That's what 5 of the biggest names in tech, Microsoft, Amazon, Google, Meta, and Oracle, have promised to spend building artificial intelligence. And that trillion-dollar number isn't me being dramatic. It comes from the Bank for International Settlements. Think of it as the world's most cautious financial referee, the institution other central banks answer to. They committed it in about 18 months, betting we'll all want to talk to a chatbot forever. So here's the fair question a bet that size earns, and I'll show you it's already starting to wobble. If it goes wrong, who actually pays? You can already see that wobble in one strange little episode, and it's the whole story in miniature. On July 1st, Bloomberg reported that Meta was building a side business to sell off its spare AI computing power. The data center capacity the report says it had built but wasn't using. New York cheered, a clever new way to make money, and Meta's stock jumped as much as 9%. But the next morning in Seoul, the exact same headline hit like a threat, and here's why, because it matters. If Meta has so much AI capacity that it can sell the leftovers, then maybe the whole industry has built too much. And the ones with the most to lose from too much are the companies that supply the hardware. 2 of the biggest sit in Korea, Samsung and SK Hynix, which make a huge share of the world's AI memory chips. So Korea's market fell hard. SK Hynix alone dropped more than 14%. Same news. One side heard new profits. The other heard the buying is about to slow. And this wasn't a one-day crash. It was the third little sell-off in 5 weeks. And the market bounced right back the next day. Down a step, bounce. Down another step. That slow, arguing slide is what a bubble looks like when it deflates in slow motion, instead of popping all at once. Now, the comforting answer to who pays goes like this. Relax. These are the richest companies in history. If the bet sours, they'll cover it out of pocket. And for years, that was true. Then it quietly stopped being true. The companies that never needed to borrow have started borrowing to pay for this. More than $100 billion of it last year alone. And borrowed money works differently from a company's own cash. Here's the part that matters. If the bet goes bad enough that the borrower can't pay the loan back, the loss doesn't vanish. It lands on whoever lent them the money. And if that lender borrowed too, it lands on the next one down. It rolls downhill toward whoever's standing lowest. And you might be standing lower on that hill than you think. So that's the real question this whole video answers. When the losses come, who actually eats them? We're going to follow the money straight down, from the giants at the top, through companies you've never heard of, all the way to the bottom. And the bottom is closer to home than you'd like. Full disclosure, I refreshed my own brokerage app twice while researching this. Diligence or anxiety, I've decided not to find out. One phrase to pocket for the ending. It'll click later, when the music slows. Let's follow the money. To see how we got to that split screen, rewind about a week, to where the slow slide really began. June 23rd, Seoul. Korea's stock market fell almost 10% in a single day, its worst point drop on record. It dropped so fast that trading actually froze. That's a circuit breaker, an automatic timeout that kicks in when a market falls too hard, too fast. And here's the tell. No company had reported bad news. What lit the fuse was a warning. Regulators had just waved through funds that let ordinary people double their bet on 2 Korean chip stocks, Samsung and SK Hynix. You make twice as much when they rise, and you lose twice as fast when they fall. And about 92% of that money was regular households. The moment a watchdog said out loud that this looked dangerous, the whole thing buckled. Same day in the US, Micron, an American memory chip maker, dropped more than 13% after a 1-year run of over 750%. No jokes on this one. A lot of ordinary people just got hurt. The very next day, Micron did the one thing that should have ended the scare. It reported earnings. And not just good ones. Revenue about 4.5 times bigger than a year earlier. Arguably the best quarter in the history of memory chips. Micron's own stock shot up almost 16%. So the panic's over, right? Except look wider. The NASDAQ, the main US tech stock index, the thing your retirement fund probably tracks, still closed lower that day. Sit with that for a second. The best earnings anyone could remember lifted the one company that reported them, and the whole market around it sank anyway. That is the hinge this entire video swings on. Overnight, the question everyone was asking flipped from how good are the earnings to, okay, but how long can any of this possibly last? Then, on the Sunday wedged between two of those crashes, the referee blew the whistle. Remember the BIS from the Open? The most cautious referee in finance, the institution other central banks answer to? It published a warning, and it did something unusual. It named history's great booms out loud. Canal mania in the 1830s, railways in the 40s, the electric boom of the 20s, the dot-coms. Every one, it said, was a genuine technological breakthrough that still, quote, attracted capital in excess of what commercial returns could ultimately justify. Plain version, every one of them was real, and everyone got overbought. Two different things, both true at the same time. And notice the timing. The market crashed before this warning and crashed again after it. Nobody was waiting to be told. Put those 3 days together, a crash with no bad news, record earnings that couldn't lift the market, and the referee naming the pattern, and you can finally crack open that opening paradox. Why did one Meta headline send New York up and Seoul down? Because the two sides were never holding the same thing. To Meta, we can sell our spare computing power is reportedly a shiny new way to make money. But to every company that sold Meta those chips, the exact same sentence is a quiet confession. Maybe we all built too much. One fact, two completely opposite exposures. So here's the lens to carry down every floor from here on. The demand for AI is real. The financing behind it is fragile. Real demand, fragile financing. Hold both in your head at once. So what does fragile financing actually look like up close? Let's follow the money. Now let's follow that money up close and watch where it comes back. Start at the top with the most famous number in the whole boom. Nvidia, the company that makes the AI processors, the expensive brains everyone's fighting over, announced it was investing $100 billion into OpenAI, the ChatGPT company. Read that again. A chip maker, putting money into its own customer. But read to the end of the press release too. It wasn't a signed deal. It was a letter of intent, which is just a we intend to, with no obligation to actually do it. What's actually been paid is $30 billion, and by this spring, Nvidia's own boss called the rest unlikely. So the headline said $100 billion. The real check so far is 30. Hold on to the shape more than the number. A chip maker putting money into the customer that buys its chips. Now watch that money come back around. Here's what OpenAI does with money like that. To build AI, it needs massive computing power, which it rents from the big cloud companies, Microsoft, Oracle, and a newer one called CoreWeave. And it has promised them staggering amounts over the next several years. About $250 billion to Microsoft, a reported $300 billion to Oracle, $22 billion to CoreWeave. Notice those are promises to spend, stretched over years, and they add up to far more than Nvidia's $30 billion investment. So this isn't $1 racing around a track, it's the same small group of companies wiring money and promises to each other. And here's the loop. Those cloud companies take real dollars and spend them on chips, Nvidia's chips. By Nvidia's own numbers, the big clouds are about half of its data center sales, and data centers are nearly its whole business. So look at Nvidia's two hats. At the top, it's an investor in OpenAI. At the bottom, it's the supplier the clouds pay. Money goes out as an investment and comes back as chip sales, around the same tight ring, with everyone on it counting their slice as growth. That's what circular means. A handful of companies funding each other, each booking the other's spending as its own boom. Now, the strangest deal on the whole map? Slow down for this one, because once you see it, you see the whole game. AMD is Nvidia's smaller rival, the other big maker of AI processors. To win OpenAI as a customer, AMD didn't offer a discount. It gave OpenAI something called a warrant, the right to buy shares later at a set price. Except the price here was 1 cent for 160 million AMD shares, essentially free stock, up to about 1/10 of the entire company. Think about what that does. OpenAI now stands to own a slice of AMD, so OpenAI actually wants to buy AMD's chips. Because the more it buys, the more valuable its own nearly free shares become. AMD paid its customer to be a customer, using its own stock, and the catch that chains it to the boom. OpenAI only earns those shares as it actually buys the chips, and as AMD's stock keeps climbing. A machine that runs beautifully, as long as the growth is real. The kicker, those shares cost OpenAI about $1.5 million to claim, and today they'd be worth close to $90 billion. That's not a typo. Remember I said the giants had started borrowing? Here's what that actually looks like, and why it makes everything fragile. Meta needed $27 billion for a data center and didn't want that debt on its books, so it set up a separate company whose only job is to hold the loan, keeping it off Meta's own books. It reportedly named that company Beignet, after the pastry. When your debt needs its own company to live in and you name it after a donut, I have questions. And the scale is genuinely new. Meta also sold $30 billion in bonds. A bond is just an IOU sold to investors, a promise to pay them back later, with interest. The companies that used to buy everything with cash are now, in effect, running a giant credit card. Hold on to that word, debt, because it's the thing that decides who gets hurt. And this isn't just me connecting dots. That same cautious referee from the start, the BIS, looked at this exact pattern and named it in print. The circular financing within the AI ecosystem, with one line worth remembering, that borrowing does not disappear by being out of sight. In plain terms, parking your debt in a side company doesn't make it vanish. Someone still owes it. One confession. On this map, I've deliberately left one arrow off. It's the most important one, and I'm holding it back. Near the end, when it snaps into place, this clever circle stops looking clever and starts looking dangerous. But first, the obvious question. If these companies are largely funding each other, how much of this demand is real money from the outside, actual paying customers, versus the circle paying itself? That's just arithmetic. Let's do the math. So let's answer the rude question we left hanging. If all that money is just circling, how much real demand, actual outside dollars, is there to fill the gap? Grab a napkin. This year, those same giants plan to spend about $700 billion building AI. The money actually coming back from AI products, even counting the biggest names, even rounding up in their favor, is only around 100 to 150 billion. So the spending is running roughly 5 to 7 times ahead of the money coming in. And they are not covering that gap out of spare change. These companies used to reinvest about 40 cents of every dollar they earned. Now they're plowing in every cent and then borrowing for more. Oracle is already burning through its own cash. Last year, it spent over $20 billion more than it took in. And when the first big player visibly runs low, that's your canary in the coal mine. To feel how big that hole really is, put it in terms of your own phone. For AI to earn a normal profit on $700 billion of spending, one big bank, JP Morgan, worked out the number. It would have to pull in about $35 a month from every single iPhone user on Earth. Every month. Forever. People have been trying to size this hole for 2 years now, and the estimates only keep climbing. But that $35 a month is the version you can actually feel in your gut. I audited my own subscriptions after reading it, purely out of spite, and I regret to report I am not paying $35 a month for AI. And here's the tell that the insiders feel the hole too. Even the biggest spender flinched. OpenAI quietly walked its own spending plan down from about $1.4 trillion to around $600 billion. Two figures that measure slightly different things, but a retreat is a retreat. Now, the honest half of the story, and it is not a footnote, it's the whole reason this is hard. The demand for AI is genuinely, boringly real. This is exactly where the doom and gloom videos look away, so let's stare right at it. Google's cloud business grew 63% in a year. Microsoft's grew 40%, Amazon's 28%. Those are not dying businesses. They're enormous ones, speeding up. Google's own boss says flatly that they're compute constrained. Plain version. They literally cannot build data centers fast enough to keep up with demand. And the buildings are not sitting empty. Only about 1.5% of data center space is vacant, a record low, and roughly 3/4 of everything still under construction is rented before the concrete dries. So look at our lens again, both lights on at once. The demand is real. The financing is fragile. That tension, not doom, not hype, is the whole video. So which is it? Real growth or a bubble? Here's how unsettled this is. Even a single Wall Street bank will keep a bull and a bear on staff. One saying, not a bubble, the other saying the opposite, from the same building. Nobody actually knows. But the strangest fact of all is this. The people spending the $1 trillion mostly agree it might be a bubble, and they spend more anyway. Listen to the three biggest. Sam Altman, who runs OpenAI. Someone is going to lose a phenomenal amount of money. Jeff Bezos of Amazon. It's an industrial bubble, and it could even be good. Mark Zuckerberg of Meta. Misspending a couple $100 billion would be very unfortunate, but the risk is higher on the other side. Each of them said out loud, probably a bubble. Each of them then spent more. And that is our master metaphor arriving. Musical chairs. Except in this game, you don't lose by grabbing a chair. You lose by sitting down first. Because sitting means quitting the AI race. And maybe missing the biggest thing since electricity. So nobody sits. Everybody keeps circling, faster. And the music doesn't stop, it just slows. Gaps this size existed in the year 2002. Back then, it took 2.5 years to matter. So before we find out who's left standing, let's look in that mirror. So let's give the bulls their strongest case. Honestly, no straw men. On paper, today's prices even look a shade tamer than the dot-com peak. And the bulls' best point is real. These AI leaders actually make money, unlike the dot-coms, which were mostly ideas. All fair. And all a trap, because real earnings do not make you a safe stock. Exhibit A, Cisco. In the year 2000, Cisco was a real profitable company, the literal plumbing of the internet. And it still fell 88%, and 26 years later, has never once climbed back to its old price. Real earnings don't make you a safe stock. They make you a real company that can still fall by nearly 90%. And one thing is genuinely worse today than in 2000, crowding. The 10 biggest companies are now almost 40% of the entire stock market, and Nvidia is the single heaviest stock it has ever carried. Remember that, because it quietly decides whose money is on the line when one chair wobbles. And this is where the title earns its keep, because the year 2000 did not pop, it hissed. The Nasdaq bled 78%, but it took 2.5 slow, grinding years to do it. And the whole way down, it kept throwing off rallies, up 20, 30%, each one loudly convincing people the bottom was finally in. The market even has a name for those, sucker rallies. A cruel term, but an honest one. Every single one was a trapdoor, and the overbuilding was just as real. Telecom companies laid enough fiber optic cable to wire a continent, and by one count, only about 3% of it ever got switched on. Some of it left dark on purpose. So here's the lesson. Big bubbles usually don't burst. They leak, slowly, expensively, for years, which tells you how this one probably ends. But it still doesn't tell you the thing we actually came for. Who pays? And that's the part that has quietly changed since 2000. So what actually changed since 2000? Back then, when the bubble unwound, it mostly burned shareholders, the people who own the stock. And owning a share has one mercy. You can only lose what you put in. They took the hit and went home. Debt is a different animal. This boom is increasingly built on borrowed money, and debt comes with lenders, and lenders have rights, which means a loss doesn't die with the borrower. It travels down the chain of whoever lent the money, toward people who never placed the bet. A lot of that lending is something called private credit. Plain version, loans that don't come from a bank at all, but from investment funds packed with pension money and insurance money. Lending to AI this way has gone from basically zero to over $200 billion, and it's being priced as if it were perfectly safe. The BIS says it about as bluntly as a central bank ever will. Either the lenders are underpricing the danger, or the stock market is overpricing the payoff. One of them is wrong. And what is all that debt secured against? The chips. Meta, for one, sold bonds that don't come due until 2049 to help pay for a data center. That's more than 20 years of debt against machines that stay useful for maybe 4. Meanwhile, the chips securing all that debt are quietly aging. One well-known investor, Michael Burry, the big short guy, and a short seller, meaning he profits if these stocks fall, so weigh his words with that in mind. Argues the companies flatter their profits by pretending the chips last longer than they really do. Nvidia fires straight back. Its chips from 2020 are still running hard and earning their keep. You don't have to referee that fight to see the shape of it. One skeptic sums the whole fear in an image I can't unsee. A data center full of chips is like a warehouse full of bananas, hugely valuable and quietly rotting. Debt borrowed against rotting bananas snaps at the weakest plank first. So let's line up the planks and rank who cracks. Pop quiz, and I'll actually grade it. When this cracks, what cracks first? Option A, Nvidia, the giant everyone watches. Option B, OpenAI, the famous one. Option C, a company most people can't even name. Or option D, the twist ending, your electricity bill. Hold your answer. What follows is the order the professional pessimists expect things to break in. And one short seller in particular, Jim Chanos, who is paid to be gloomy and has his bets placed against these very names, so discount him accordingly, puts the fragile end first. And every floor we're about to walk down shares one cruel feature. It's somebody who literally cannot stop playing, even though they suspect the music is slowing. So let's take the staircase down one floor at a time and see how close to your own front door it gets. The answer is C, the company you can't name. Floor 1 is a whole breed of company the industry calls neoclouds. Plain version, outfits that borrow enormous sums to buy chips and rent them out by the hour. It's the landlord business, except these buildings age like laptops. Take CoreWeave. It carries almost $25 billion of debt against about $2 billion in quarterly sales. That's roughly $12 of debt for every dollar it brings in each quarter. And a single customer is 67% of its whole business. By its own filings, it loses money every quarter, which means the borrowing can't stop. It's a cyclist who only stays upright by pedaling. And remember that one arrow I deliberately left off the money map back at the start? Here it is. Nvidia, the company selling CoreWeave the chips, also promises to buy back CoreWeave's chip capacity if no one else rents it. Read that twice, because your brain will refuse it the first time. The manufacturer guarantees its own customer, so the customer keeps buying from the manufacturer. The circle even holds up the ones falling out of it. Floor 2, the AI labs themselves, the ones actually building the models. We already watched the biggest one, OpenAI, quietly cut its spending plans roughly in half. Another lab's reported losses sit in leaked internal documents, so I won't read those to you as fact. But one number is right there on the public record. xAI, the lab behind Grok, is burning through cash at a ferocious rate. It's in black and white in the securities filing. Floor 3 is Korea, and here the jokes stop because ordinary people are getting hurt for real. Two chip companies, Samsung and SK Hynix, make up roughly half of Korea's entire stock market, half a country's savings, riding on memory chips. The last time this exact chip cycle turned, prices fell 51%, and then another 65% on top of that. And this floor has already reached you. Memory chips just got more expensive, and that extra cost, call it a memory tax, is landing on the price of new phones and laptops right now. The bubble is already on your receipt, and you never bought a single share. Floor 4 is on a timer. All that data center debt is being bundled up and sold off to investors as bonds. $30 to $40 billion a year, one big bank projects. And the credit analysts who watch this stuff pencil in the first real defaults for 2027 and 2028. Even Microsoft's own boss has said the quiet word out loud: overbuild. Floor 5 is Nvidia itself, the toll booth every other player has to pay to get on the road, which is exactly why it falls dead last. But last isn't never. Just 4 customers make up 61 cents of every dollar Nvidia earns. So if a few of them wobble, even the toll booth feels it. And floor 6, the slowest and stickiest floor of all, is the electricity grid. Utilities are building it out for data centers that may never actually get built. The requests on file run 5 to 10 times more than what's really coming. And when all that half-built capacity strands, the cost doesn't just vanish. It slides quietly onto ordinary people's power bills. Now hold still, because This is the whole video. Pull the camera all the way back from the musical chairs and look at the room for the first time. The players are still up there circling the chairs, refusing to sit. And yes, they're mostly billionaires, and it's tempting to decide this is their problem. So look down instead at what the chairs are actually made of. Every floor we just walked down was built on borrowed money. And the question we've dodged this whole time is, borrowed from whom? Follow the legs of the chairs to the ground and there's your answer. This leg rests on private credit, this one on the bond index, which by some measures is now its single biggest slice, yes, the boring bond fund in your retirement account. This one on pension money. This one on your index fund, where almost half the market's weight is now this one AI trade. And this last leg rests on your monthly power bill. Now widen the shot all the way and meet the person who's been holding the entire game up from underneath. You were never in the audience. Your savings are the legs of the chairs. And that is the answer to the question we opened with. Who eats the losses? It was always going to be whoever was standing lowest on the hill. That's you. So let's land this. Right now, half the internet is still arguing about whether there's even a bubble at all. And here's the part that took me a while to see. That argument is the deflation. When something pops, nobody debates it, they run. When it leaks slowly, people stand around arguing about whether the tire's really going flat while the air quietly hisses out. That staircase we opened with, down a step, a bounce, down again, isn't the calm before the drop. It is the drop. That's just what it sounds like when it's polite. Now go back to where we started. That 1st of July, one headline, two opposite prices, and watch it finally read clean. Meta went up and Korea went down on the very same news. And it was never really a paradox. The two sides were simply holding two different things. One side owns the demand, the real, genuinely growing part of this story. The other side is holding the financing, the fragile, borrowed part. Same news, two exposures, exactly like every floor of the staircase we just climbed down. And it is always the second side, the financing side, where the crack shows up first. That's the whole trick to reading this story. Not who's in the news, but which of the two things they're holding. So here's the one tool to keep in your pocket. The next time someone at dinner asks, "So, is AI a bubble?" Don't answer it. Swap the question. Is it a bubble? Is a yes or no argument that spins in circles, exactly like the money does. Ask a better one instead. Who is carrying the debt? And could they still carry it if the music just keeps slowing down? That single question cuts through all of it. Real demand and fragile financing can both be true at the same time. They are. And it's the financing, quietly, that decides who ends up holding the bag when the chairs finally stop paying out. Two honest caveats, because I'd want them myself. One, the demand really might catch up. Even the gloomiest credible skeptics land on a growth number that's positive, just smaller and slower than the hype. And two, nobody, me very much included, can time any of this. It hisses for years as a warning, not a stopwatch. Betting on exactly when is how bears go broke being right too early. And keep this firmly in mind about our loudest bears. Several of them are short sellers, investors who make money precisely if they're proven right. So weigh every dire word with that in view. This is not financial advice. It's a map of the plumbing, drawn by a cat who refreshed his brokerage app twice and lived to tell you about it. If this map made the machine a little clearer, do me one favor. Like it, share it with the friend who keeps asking whether AI is a bubble, and drop a comment telling me what you want mapped next. The BIS reports and the full list of sources are linked below. I'm Milo. Watch who's carrying the debt when the music slows. See you next time.